Hello, my name is Bryant Sikorsky. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners, and I will be your host today on the topic of calm, cool, and invested, staying on track for the life that you want. Now, myself, I was born into the kind of an atypical American family in a small suburb outside of Detroit, Michigan, and while we were no means wealthy, we weren't really hungry either. But that all changed when I was a teenager. My father passed away unexpectedly at the age of 49, leaving me, my mother, and my three siblings uncertain about our financial future. Now, we eventually made it, but our lives could have been much improved had my parents planned a bit for the unexpected. And today, as an independent wealth advisor, my passion is to ensure that my clients and their families never have to go through what I did. So I specialize in helping individuals, executives, and small business owners at their peak earnings years plan for the unexpected while transitioning from their portfolio accumulation to what I call their portfolio distribution phases. To do this, I follow a defined financial planning and investment management and wealth transfer process to give them the peace of mind knowing that they will never run, quote, out of money. I bring over 20 years of financial advisory experience. Certification is both an accredited asset management specialist and a chartered retirement planning specialist, and hold a master's degree in business administration. Now, today we're going to cover the topic of calm, cool, and invested. In my heavens, with today's market and economy and news, what more could you ask for here? Goodness gracious. So how to stay on track to the life you want. So now my company, Stratos Wealth Partners, is considered a registered investment advisory firm. And a company called LPA is my broker dealer. So these two entities help me as an independent financial planner and wealth advisor run my business correctly and legally and ethically. So there's some common questions I think that most people have about investing, and usually it kind of wraps around: how much do I need? Is it too late to start investing? And what if I pick the wrong investment? And do I know enough to make these important decisions on my own? These are all very good questions, and the good news is you don't need to know or have all the answers. I think the most important thing is the key is to ask for help when you need it. Now, if you think about it, when you feel sick, you go to a doctor. When you want to buy a house, you go to an attorney to review the paperwork. So we have a habit of only reaching out to professionals or going to them when something is very important to us, or when we know we're out of our area of expertise. So it's a little perplexing at times why then so many individuals just kind of open up their investment statement each quarter, glance at the balance, and then file them in the circular file, I guess hoping for the best and wondering if we're really on track. So, as the president would say, come on, man, who in the audience would want to do that, or who would do that? So for all of us, our finances are very important to us. And for most of you, it's probably not your area of expertise. So it might be to your benefit to consult with and work with an investment professional to help you answer questions along the way. And I know that some of you have not worked perhaps with an advisor before. So I'm going to cover just very briefly how that process works, because I think a lot of people are very intimidated by it. So getting started with an investment professional is really very easy. It starts all with a conversation. That advisor will listen carefully to you as you describe your future hopes and dreams, and maybe even your fears. And he or she will ask questions along the way to help you think through different scenarios and set your own priorities. Then they use all of this good information to develop a financial strategy designed to help you work toward your goals throughout your lifetime. But what exactly is a financial strategy, you might be wondering? Well, a financial strategy, if I could pronounce it, is a summary of your life goals and a blueprint of how to financially prepare those goals, or pursue, I should say, I'm sorry. Your investment professional will also provide guidance on techniques that will help you pursue your financial strategy. Now, it's interesting, I heard a statistic one time that said that most people spend more time planning their summer vacation than they do planning for their financial well-being. Kind of frightening. So despite this technical looking slide, the concept of compound interest is actually quite simple. If you think about it, it's a bit like a snowball. You start with a small handful of snow, and after rolling it over and over again, the ball gradually becomes bigger and bigger. Likewise, if you open an investment account and let that money potentially grow, rolling any income or capital gains you receive back into the account can grow very substantially over time. So in this chart, we start with a hypothetical investment of $1,000 and demonstrate how 3 different investments grow over time. A more conservative option achieves $3,262. A moderate option achieves $7,040, while the most aggressive approach yields $10,286. Now, the real challenge too, I think, is to recheck your gut, if you will, periodically, like maybe once a quarter or twice a year. Because last year, when everything that you threw a dart at was up 25%, everybody became an aggressive investor. Now, with the market down over a quarter since the beginning of the year, those same so-called aggressive investors are calling me up saying, how do I get out of the market? So I think you really want to put together that, or go through that. I have a questionnaire that I use to go through that and make sure that you're at the appropriate level of aggressiveness or conservatism. Because fundamentally, not everybody should be in the stock market. Some people just emotionally and behaviorally do not have the patience or the gut or the guidance to tolerate volatility. So as you see in this example, all 3 investments grow considerably over time, thanks to the power of compounding. And the key here is to get started as early as possible and to reinvest your any earnings along the way, because time is your friend. Keep in mind that investment returns and principal values will fluctuate with changes in market conditions. Now, I hear, everybody on everybody's mind these days is the topic of inflation. And inflation fundamentally is an increase in prices. And the reason we want to keep ahead of this is because inflation can erode the purchasing power of your money over time. We're seeing this now. If you go to the grocery store today, I will tell you right now, you will pay more than you paid 6 months ago. And I think the most obvious is in a gallon of gasoline, which here is kind of interesting. It's dated 2021. It says $3.41 a gallon. Good luck finding that. So prices rise over time. And the reason that a financial professional will factor inflation into your strategy is because the long-term impact on your nest egg could be significant. Sure, you might meet your goal and accumulate, say, $1 million for retirement, but $1 million 20 or 30 years down the road won't buy the same amount of goods and services that $1 million will buy you today. Again, time is a friend. Time is on your side when it comes to your financial strategy. And getting back to our financial strategy, the next important step to creating a plan is to choose the investments that you're going to include in it. I've been watching, I don't want to call it binge watching, but I've been watching, you know how it is on YouTube. You pick one show, and when it's done, then they have 50 just like it they want you to watch. And I've been watching Kitchen Nightmares. So maybe I should get myself all excited and start, using my hands and arms. But then again, my language would get pretty salty. So once your financial professional puts numbers behind your goals, how much to put away and for how long, it's time to discuss where to put that money. That's where a three-step process I like to call ADR comes in. A stands for allocate, D for diversity, and R for rebalance. Now keep in mind that no investment strategy, including ADR, can guarantee a profit or protect against any type of loss. So let's start with allocation. So once your financial professional puts numbers behind these goals, we're going to figure out where to put the money, and we're going to create an asset allocation strategy, which is a term that simply means a plan for investing your money across different types of investments, like stocks, bonds, money markets, etc. This strategy will take into consideration your comfort level with risk and how much time you have before you expect to reach your goals or need to access that money. This slide shows the types of investments your financial professional will consider. It's important to note how different securities act quite differently over time. That is why he or she will recommend a combination of investments, which is your asset allocation strategy. Now, for those adrenaline junkies out there, and I know you're out there, maybe wondering why spread the money out after all? Why not just go for the stock investments? Well, spreading your savings around diversifies your investment portfolio, which helps manage risk. So let's take a little bit closer look at that. As we've just seen here, where stocks average 12%, in this time frame, bonds about 7, treasury bills about 6, and inflation at 4.4. So we have a very interesting chart. We look back in time and plotted performance for a wide range of investment securities, with each color square representing a different type of investment and how it performed that particular year. The gray box is commodities like copper or oil. The dark blue box represents bonds, and the dark purple box is international stocks and so on. By the way, this chart appears on pages 8 and 7 of the brochure that goes along with this presentation, and we can go back even farther, like 10 years or more. So if we look at the dark gray box, which represents a diversified portfolio, which invests a little in each one of the securities, see how fluctuation is tempered and growth is still achieved. We call this the bubblegum chart because of all the different little colors on it. And you'll see too that if you look at it, it's not uncommon that you look at a sector that is just horrible one year and fantastic the next year, and vice versa. So if we look at, let's say, 2020, real estate investment trusts in the powder blue was at the very bottom, the negative 5.86%. But then the very next year in 2021, look where they were. Real estate investment trusts in powder blue was 39.88%. So essentially what diversification does is keep you from experiencing that type of a scenario where one year you're up 39 and the next year you're down 5 or worse. Look at commodities in the lower left-hand corner from 2012 to 2015. They were negative every single year, with its worst year being down 25% in 2015. So now we've allocated and diversified. Do you set it and forget it? Well, no, that's where the last factor here, or of rebalance, comes in. This is just the different colors that were represented on the chart and what they relate to. So why should we rebalance? Well, the markets are continually changing, and over time, those changes can alter your portfolio's mix of investments. rebalancing can bring your mix of investments back in line with your risk profile. Unfortunately, trying to time the market and chase investment returns have often left investors with nothing or little or nothing to show for it. But when you allocate, diversify, and rebalance, you can pursue your goals with a smart long-term investment strategy based on your specific goals, time horizon, and tolerance for risk. So some key points to remember. With market performance, the relative market performance of asset classes shift over time, which may alter your portfolio's mix of investments. Stocks will typically outperform, and they will outperform bonds, and your allocation to stocks may increase, potentially increasing portfolio risk. While rebalancing consistently can help you keep your portfolio at an appropriate level of risk based on your individual risk profile. So here we look at the performance of the US stock market as measured by the S&P 500 index over the course of 20 years. The first scenario shows performance if you stayed calm, cool, and invested. The second scenario shows performance if you sold and didn't get back into the market in time for the best 10 days. And likewise, the next two bars show how you would have performed if you missed the strongest 20 and 30 days. Now, just to reinforce this point a little further, the average performance of the S&P stock index is 9.52% over 20 years ending December 31st of 2021. But the average investor return is only 5.96% according to the 2021 Dalbar Quantitative Analysis of Investor Behavior. So you can see how sticking to your plan in the face of a market upset can serve you well. Now, we talked about a lot of different approaches to investing, making a plan, starting early as soon as possible to potentially boost returns, selecting investments, diversifying to help reduce risk, regularly rebalancing. Now let's pull all these three things together and let's look at an example with our friend here, Margie. As Margie approached retirement, she and Carol discussed how to transition her retirement plan from the accumulation phase to the distribution phase, where she begins to take withdrawals to support her lifestyle in retirement. Carol recommends that Margie take 5% out of her nest egg the first year. Each year after, she will take a little more to accommodate inflation, which will make her groceries, travel, and entertainment a bit more expensive. This is not a concern to Margie because Carol built expected inflation into her plan back when she first opened her account. Now, Carol also recommends the nest egg invested for future growth potential. They've targeted a 20-year retirement. Now, 20 years is a long time, and Margie wouldn't want her now large portfolio sitting in a bank account earning next to nothing when it still has the potential to grow. So as you can see here, and you can see where Marge began taking withdrawals, her portfolio still grew over time. It also fluctuated, which is why Carol kept it in her diversified portfolio with a mix of bonds for income and stocks for growth potential. So kind of wrapping some of this up, we're going to come back to our main point here again is the calm, cool, and invested strategy, which is, I think the key is finding a good investment partner with your financial professional. Working with a professional that you're comfortable with will give you the tools and the guidance necessary to summarize your life goals, create a financial strategy to help you achieve those goals, choose investments that make sense, how much and where to invest, and monitor your financial strategy to make sure you stay on track and meet your goals. So I want to say thank you for joining me. I will wrap this up by sharing with you that I've recorded this webinar, and I will upload it to my YouTube channel probably tomorrow. So if you look on the screen here, you can see my homepage, which is briansikorsky.com. And if you click, a couple things here. One, if you scroll down to the bottom of the website, you can see the outlook for the markets in 2022. We're coming out with a revised copy in about 2 to 3 weeks. So this will be the mid-year outlook for 2022. Also, this weekly market commentary, it comes out weekly, but it's an excellent publication to take a look at that lets you know what's going on in the recent markets. And this is a very good one I just read today on the topic of bear markets. Now, if you want to watch this presentation again that we just completed, you can go up here to my YouTube channel and click on that icon. And this will take you to my YouTube channel where I've got, I don't know, 30 or 40 or so different presentations, different webinars that you might want to look at. So you can look at this at your convenience. And I've got everything from long-term care to insurance to women in investing to college savings, etc. And I usually put up at least one, sometimes 2 videos every month. So with that, I'll say thank you very much for joining me. If you have any questions or like to reach me, my name again is Brian Sikorsky. You can reach me, as you can see here, at my website, briansikorsky.com, where I have my phone number and my email address. So with that, I'll say thank you and have a great rest of your evening.